You're watching Inside Automotive with Jim Fitzpatrick.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining me on another edition of Inside Automotive right here at CBT News. Today we're diving into the latest market dynamics with Erin Kerrigan, founder and managing director of Kerrigan Advisors. So Erin, thank you so much for joining us on the show once again.
Thank you, Jim, for having me. It's nice to talk over this beautiful summer
That's
season.
right. So tell me, how is the second quarter shaping up so far?
Well, it is turning out to be a busy quarter. We are definitely busy here at Kerrigan Advisors. Obviously, sales in the marketplace, the SAAR is down a bit from the strong March and April. I think we came in at about 15.6 in May. And it looks like June will also likewise be down. So, of course, we always like to see new car sales growing and not slowing. We all know what's driving that. I think there's a little bit of uncertainty in the market from the consumer side.
Sure.
Inventories tightening, vehicle affordability is certainly a challenge. However, when I speak to dealers, they do seem optimistic all in all for the year. I think that grosses are holding up nicely, and that's certainly a positive for profitability. So we do see profitability remaining nice and steady, definitely not falling off a cliff.
Okay. How did inventory, or I should say, how much did inventory tighten last month, given the March and April sales rush and delayed vehicle shipments? Given the tariffs.
Well, it was pretty pronounced. The new vehicle inventory was down 10%. From the May of last year, and I think June will be down again. So we're running at about a day supply of 60 days,
okay.
and that's a healthy day supply. Obviously, if it goes much lower, if we start approaching the 50, 40, and even 30, then that changes the dynamics. Although we all know what happened last time when day supply got very low, margins grew and dealers did quite well. So it's one of those things where we certainly want to have inventory available for the consumer, for our industry. It's not all bad when inventories do shrink. I think
right.
that the scarcity creates some demand just naturally in consumers. I think finished vehicle shipping declined 9% May over May, so year over year. So that certainly is an indication that the inventory situation is driven by the tariff situation.
Mm-hmm. And also you save on floor plan, as a dealer, right? And you don't have that 90, 120 day inventory sitting behind your store.
Well, we saw that, and we were all hoping, quite honestly, during the pandemic, that the OEMs would have learned a lot of lessons, that everyone benefited when the inventory was slightly lower than the demand. It really created a dynamic of high turn, high efficiency.
Yep.
The productivity of the average dealership in terms of revenue per employee was incredible, and all of that resulted in a much more profitable business model. Perhaps we're going to return to that a bit due to the tariff situation.
Yeah. Talk to us about the tariff situation. What's from your perspective, what's the latest on that?
Well, I don't have a crystal ball on when this is all going to be finally negotiated. I will say what we see in the marketplace is that most buyers seem to expect that the tariffs will get resolved by the summer sometime, maybe by the end of the summer, and that ultimately it will be something that the OEMs are going to have to take the lion's share of the expense. The reality is the consumer's on their tippy toes, so the consumer doesn't have much room to grow in terms of paying a higher price for vehicles, and dealers need to make a good margin, or they won't actively sell new vehicles. I mean, that's like any sales force needs to be paid to do their job. And
sure.
So the reality is, I think the OEM is going to be taking most of the hit as it relates to tariffs, both in terms of improving their own productivity,
right,
and also, quite honestly, reducing the margin that got quite inflated during the COVID period. So we saw OEM margins double in many cases. And so those will probably come back down to earth as well.
Okay. And how are valuations holding up in light of tariffs?
Well, it's interesting again because what we see is most buyers expect these tariffs will get figured out. We have not seen the tariff situation impact valuations. In fact, if you look at the Kerrigan Index, which is our proprietary index of the 7 publicly traded auto retailers, it's hovering around 1,000, and that's not far off its all-time high. It's up 4% for 2025, and that's double the rise of the S&P this year. So we do see that Wall Street is pretty optimistic about the auto retailers and valuation from a public standpoint. And if you look at the biggest movers, Sonic's up 21% year to date, Penske's up 11%, AutoNation's up 8%.
Yeah.
In fact, Sonic hit an all-time high in its valuation on Monday after Bank of America upgraded their outlook. So pretty positive on the public standpoint for sure.
Yeah, that's great. And what about private dealer valuations? Are they holding up as well?
They are. And what we see, we have the Kerrigan Blue Sky Index, and the Blue Sky Index, which really reflects the valuation of the private sector of our industry. It's still 70% higher than the pre-pandemic level. And we've kept it flat based on what we're seeing in the marketplace from last year. So it's remained at its elevated level since the end of 2024. We're not seeing valuations move dramatically. Now, of course, that's the average. So we are seeing some ups and downs within specific franchises. And in this regard, some positive momentum for some of the ones that were more of a laggard. We're seeing CJDR, for instance, improve from its low of 2024 when there was a lot of avoidance of the Stellantis franchise. We are now seeing buyers leaning in. In fact, we just closed this week on a sale for Asbury Automotive. We helped them to divest of 3 domestic franchises in Utah, including a Stellantis franchise, and there was a lot of demand for that franchise. So we were pleased to see that.
Yeah.
And so what we are seeing really valuations hold strong. What we're really seeing is the consolidation trend is not ending anytime soon.
Yeah.
And we analyzed, interestingly, the top 150 dealership groups. And we said, okay, what's their average revenue per group? And if you can believe it, it's $2.7 billion. That's average
of
those 150 dealers.
Wow.
And they represent, they're a growing percentage of the industry's market share. It's about 1/3. And keep in mind that those dealers, those 150, and that it's only 150 dealers, their average revenue is 22 times higher than the average non-top 150. Really? So what we're seeing is that more and more dealers are trying to get into that group because they do see that as an important part of their future. And I always like to say, the industry is kind of changing from playing checkers to chess as it relates to consolidation. So certain major markets, there are fewer and fewer standalone small groups and fewer standalone dealerships. And it's very clear who's the consolidator in each major market. And it's a matter of, okay, who's going to own the top franchises in that market?
Yeah.
And it's much more a lot of the buy-sell market is becoming much more strategic by specific region and by specific market. Okay.
So therein lies that you're seeing a different value based on market location.
Market location and the dynamics of a specific market. In other words, if you're in a market, I'll give you an example. If you're in Tampa, we represented the Tampa Toyota store. It was the only store not owned by a major consolidator in the Tampa MSA. So it was the last Toyota store to buy.
Yeah.
So the dynamics of that buy-sell were driven by Tampa. And so I think what we're finding is, while we do present our blue sky multiples, of course, on average, they're averages, and there's a reason there's a range, and there's a reason we spend important real estate in the Blue Sky Report every quarter to have a page and a half explaining what drives valuation and what drives these multiples up and down, because the market dynamics is becoming a more important factor driving the valuation of a franchise. If two major consolidators own a market and the last Toyota store is available, that's going to create a lot of demand for the store. Who's going to get it? So that's an example of how the microeconomic impact of each market is driving valuation a great deal, because we're starting to get into this chess rather than checkers market type.
I could see that. Sure. Are things looking brighter since, or I should say, given Trump's recent reversal?
On the carb situation, yes. No question that, what we were seeing is there was greater valuation differentiation by market, by state, especially those 12 states that were subject to the carb mandate. And that carb mandate was going to be extremely punitive on limiting effectively sales in those markets, because the market demand for EVs was not at the level that those states were requiring of the OEMs. So it effectively was putting a cap on the number of ICE vehicles OEMs could sell in those states. And that was just really going to limit the revenue opportunities of dealerships in those states. We were beginning to see that impact on buy sells, where buyers would say, well, Kerrigan Advisors, we see that you think the potential growth for this store is X, but we think it's Y, because if these carb mandates come in, we don't think we're going to be able to sell that many EVs.
Good point. Very good point. It
was really beginning we could see where this would go if these mandates came in, and unfortunately they just did not match the demand of the marketplace, the consumer.
Sure.
So I think that fact that the Trump administration signed into law what was passed by both houses of Congress was very important, because it ensures that the consumers will get what they want, not what's being mandated by the government. And that's going to mean we no longer are going to see this risk factor of what we were calling a carb discount on Blue Sky. And fortunately, that's going away. So we're very happy, and congratulations to NADA and all the NADA members and board for all of their efforts to ensure that came to pass.
No question about it. That's for sure. And it was a group effort by everybody, even the lawmakers, and and now we've got Senator Bernie Moreno fighting the good fight for us, in addition to Lee Zeldin and many others, and there in the Senate and in the Congress that have an empathy for the auto industry enough to say, hey, this is crazy. We got to put an end to this. So kudos to Mike Stanton at NADA and so many others out there that really did a great job on that, for sure. So
100%. No, it really, they saw how incredibly powerful and important it was to make sure that, quite honestly, the country has a level playing field as it relates. We can't have these, onesie twosie rules by state. It's not functional as it relates to environmental standards.
We've been seeing a lot of deal announcements in recent weeks. Tell us what you're seeing.
Well, as I mentioned at the beginning of the interview, we are very, very busy over at Kerrigan Advisors. We've been doing lots of transactions, interestingly, where, as I mentioned, this regional consolidation trend we're seeing. So we recently sold a Chevy, Cadillac, and Nissan franchise in Arizona. Casa Auto Group, which is a growing group in that southeastern region of the U.S., bought its first group in Arizona, so that's very exciting.
Wow.
We also sold a Hyundai Subaru franchise in Vermont, where the Hoffman Auto Group, also very strong private group in the Northeast, entered a new entered a new state.
That's
So
great.
with the highest volume franchises in that state. So that's another example of this trend I'm talking about, where we're seeing regional and specific market consolidation. I already mentioned the Asbury divestiture. We are seeing the publics certainly divest of certain franchises, especially as they make major inroads in markets like Asbury acquiring the Herb Chambers Group, which is expected to close very soon here in Boston, a $1.3 billion deal, equivalent to the Coons deal that they did. So Asbury continues to really lead the industry in doing these monumental transactions, and very impressive the way they continue to execute these large deals. Not easy to do.
No.
And we expect we're going to continue to see the publics do large transactions. I mean, they are, as a group, sitting on $8.3 billion of liquidity.
Wow.
And so there's lots of capital to be put to work. And certainly, as I already mentioned, the Kerrigan Index is doing very well. So they have the valuation, they have the PE multiple, if you will, to make transactions accretive to earnings. So we do think 2025 will be another strong year for buy sells. I think it'll be probably a little lower than 24 as an industry, but still far above the pre-pandemic levels. So there is definitely no dust settling over here at Kerrigan Advisors.
Sounds like it. Sounds like you're knocking the cover off the ball. So that's great. Erin Kerrigan, the founding and managing director of Kerrigan Advisors. Thank you so much for stopping by CBT News with this update. I know that our dealer community will get a lot out of it. So thanks so much.
Thanks, Jim. Have a great summer.
Thanks. You too.
Thanks for watching Inside Automotive with Jim Fitzpatrick.